Hello and welcome to Sprott Radio. I'm your host, Ed Coyne, Senior Managing Partner at Sprott Asset Management. I'm really excited today to welcome Arjun Murti, founder and publisher of Super Spiked, a Substack newsletter and podcast covering energy transition. Arjun joins us today with over 30 years of Wall Street experience covering global energy. Arjun, thank you for making the time today to join us on Sprott Radio.
Ed, I've been a long-time listener and a big-time fan, so thank you for having me.
Wonderful. Well, at least you found a way to eventually fall asleep at night. So I appreciate you being a listener. Let's go into your career. I mean, 30 years in global energy. Talk to us a bit about that and about your life on Wall Street. And then I want to dive into your newsletter and podcast. You actually do as well. But talk a bit about your history and background first.
Sure. I consider myself really lucky, Ed. I found a job that I absolutely loved out of college as an equity research analyst. And I've been doing it now for 32 years. And even as sort of my titles and some of the roles have changed, I still identify as an equity research analyst. I think there's some perspectives and some mindset that goes with that phrasing that we can get into. But the first 20 years of my career were in various Wall Street jobs. I started at a boutique investment bank in Denver. I was on the buy side at JP Morgan. And then the bulk of my career that some folks might still remember was as Goldman Sachs as the major oils analyst and led the energy business unit. And at the end, ran the research department. I had the good fortune to retire as a partner from Goldman in 2014, got to see my children through middle and high school, and was doing board and advisory work. So I joined the board of ConocoPhillips about 10 years ago as senior advisor at Warburg Pincus and two public policy think tanks at Columbia and ClearPath. And it was sometime around COVID and negative oil prices that I got kind of sucked into Twitter and started re-engaging and actually enjoyed it. So I made friends with Twitter. And that led to me creating Super Spiked, my Substack, in November of 2021, primarily because the world had really started to ramp up this idea that we're going to have an energy transition and we have to have one and it has to be fast and it has to eliminate oil and gas and go entirely into renewables and all the kind of some reasonable but a lot of unreasonable, in my opinion, perspectives around that. And I thought, you know what? I may not know a lot about a lot of things, but I do know something about energy. I do know something about energy systems. So let me start writing this Substack. It has elements of being an equity analyst, elements of being sort of macro, elements of the policy work and the board work I've done. And I've really enjoyed re-engaging on it. And in the past year, it led me to, quote, unretiring. And I joined my former colleagues from Goldman and Tudor, Pickering, Holt at a firm called Veriton. We're about 15 people in total, 5 partners, and we help energy companies think through strategy, transition, investor questions, all these kind of things. And we have a little bit of a fund as well that focuses on new energies as well.
Very cool. Well, let's talk about defining energy transition, because I think some people see it differently than others. It's one versus the other versus all in. Talk a bit about that. What does energy transition mean to you and your group?
I think I'm getting to the point where I'm thinking about maybe we need to retire the term energy transition because it's taken on a little bit of a life on its own. And the common definition, I think, for most people would be we're transitioning out of something, presumably oil, gas, natural gas, and coal, and into something else, which is overwhelmingly considered to be renewables. And then some folks will say, well, it's nuclear and some new technologies and some other things as well. And that we're all going to do this by some round number year, 2050 in this case. And, there's all aspects of that I think are quite challenging. And I'll start, and I'll try and keep this short. I'll phrase it that there's the lucky 1 billion of us, folks like me and you, Ed, that live in the United States or Canada, Europe, Australia, New Zealand, Japan, that use a disproportionate amount of the world's energy, 5 times the amount of energy on a per capita basis than what the other 7 billion people on Earth use. And those other 7 billion people, like those of us in these lucky 1 billion countries, are going to aspire to better lifestyles, better economies, and ultimately that means more energy use. We can debate how quickly that can happen. For some places, it's going to happen quickly. And unfortunately, for some places, it's going to take a long time. But ramping up their energy use and thinking we're only going to do that with renewables or electric vehicles or any singular solution is where I think this notion of energy transition has gone off the rails. And whether it should be energy evolution or energy diversification or frankly just energy growth, but hopefully in a lower carbon, lower environmentally impactful manner, that's what I think we're headed towards versus this very, I'm going to call it ideologically driven version of transition, which means out of something into something else on a short time frame.
Yeah, the 2050 seems aspirational at best, and I applaud, that goal. But I was talking to someone recently. I said over 80% of our energy consumption is still oil and gas, and this is going to be a very long transition. Talk about the 7 billion for a second. That's a number I don't think I fully appreciated. What if just half of them or a quarter of them decide to start buying some lamps and light bulbs and maybe a dishwasher for their house? What is that going to do to the energy demand?
Well, so I'll apologize for being historically a legacy oil analyst. I'm going to do this in oil terms. So the world uses about 103, 104 million barrels a day of oil. About half of that is these rich countries. About the other half is, again, these other 7 billion people. In the rich countries, we use about 13 barrels per person. Here in the U.S., we use over 20 a person. South Korea is 20, and it kind of varies. Europe's 10, and other countries are sort of somewhere in between. The developing world, the other 7 billion people, are using just 3 barrels per person. In India, it's barely 1.5 barrels per person for 1.4 billion people. Africa is barely 1 barrel per person for, again, about 1.3, 1.4 billion people. If you just said, what is social justice? What is economic or environmental justice? To me, as someone who is pro-capitalism, it is that we are all similarly rich. As opposed to what I'm going to call socialism, we're all similarly poor. And I am smiling as I'm saying this. So we take the optimistic capitalist view of the world. I'll say 10 barrels per person would be an equitable split if we want to use that type of language. That would correspond to a 250 million barrel a day oil market. Now, that could be 100 years from now if it takes some countries and regions a long time to develop. I also think we won't ever have a 250 million barrel a day oil market because it will imply a level of oil imports in places like India and China that they're going to be highly motivated to not go down that road. So I do think there's a huge motivation from the perspective of geopolitical security and ultimately economic development to figure out new technologies, what we might call transition. But from the perspective, the lens is, how do you make your country and people rich? And how do you do it in a geopolitically secure manner? And cost and reliability of these things are clearly important metrics as well. And so we can start shaving from the 250 downwards. Where I really push back on the term energy transition is the idea that we somehow know today what all those technologies are that are going to ramp at scale, affordable, reliable. We don't have the answer. We have partial solutions. Electric vehicles will solve a part of the problem, especially for affluent people. But for huge aspects of our energy usage, we don't know how we're going to get there. I think we're going to figure it out over the next 20 to 30 years. But the idea that we know that today and therefore can declare some goal by 2050 of net zero, that's where I think there's a lot of issues with both the objective and how it's portrayed.
Well, you mentioned something that I think few people, including myself, don't really spend as much time thinking about, which is security. I'm in New York today. You're in LA today. We sort of live on the coast and think that's the world. There's a big wide world out there that has a lot of issues to it, and security is certainly one of them. Maybe spend a little more time on that. What does that look like from both traditional energy sources like oil, gas, and even coal to some of the more, alternative energy sources like wind, solar, and nuclear, which is kind of getting a new renewed fan base?
So my starting point is that energy is essentially a hierarchy of needs. We all need it. It has to be abundant and available, and that's all we all care about. When there's a storm and there's some sort of outage, no one cares what they pay for it. No one cares what country it comes from. No one cares, is it coal? Is it nuclear? Is it renewables? No one cares. They just care that when you want to start your car, it turns on, whether it's electric or internal combustion. When you turn on your light switch, the lights come on. That's all anyone cares about. After that, you would prefer it to be affordable. No one wants a perpetually high cost of energy. And typically, the most successful economies have a very low cost of energy. That's been a huge competitive advantage of the United States, as an example. You'd like it to be from geopolitically secure countries. But I say this, Ed, the worst day of my career, it's not even a close call, was 9/11 when the hijackers took down the towers. And the next day, I was filling up my car with gasoline that de facto came from Saudi Arabia, where a disproportionate amount of the hijackers came from. And the point was simply being, even geopolitical security will take a backseat to, is it available, is it abundant, and can I get it today? From a country standpoint, in the United States, we're really lucky. We were importing 11, 12 million barrels a day of oil, thanks to the shale oil revolution, thanks to growth in Canadian oil sands. When you add up U.S. and Canada, we're basically balanced. So our geopolitical position is significantly improved. We're still subject to volatile prices, But from a dependency standpoint, the United States, in particular, this is true for Canada, can no longer be held hostage, their economy, by producers in other countries. And I think other areas are going to look at it the same way. So if you're China and you've now replaced the US as the one that's importing 11 or 12 million barrels a day, and China, Ed, is barely using 4 barrels per capita, and the US were 20. So yes, China's richer than they once were, but no one would say they're rich similar to the US or Europe, at least in the totality of their population. And if you're China and you're importing 11 million barrels a day and your consumption is 4 barrels per capita and you want to be rich, maybe you won't. That's a separate podcast. We can debate the trajectory of China, but they're going to try to be rich. That to me is their motivation to do electric vehicles. Now they're doing it with a lot of coal-fired power generation and renewables. But the point there is I don't view that as a climate objective of China. I view it as a geopolitical security objective. And when I look at India, where it's just getting going, they're barely at 1.5 barrels per capita of oil consumption. They have very little indigenous oil supply. Same with China has some more than India, but they both have very little relative to what would be a fully developed economy. They're going to be motivated to try and figure out what else can we do. And maybe what else they can do is also avoid things like SUVs, vehicle weight. So there's lots of different ways to look at this, but I think the geopolitical imperative, if you're a developing country, especially in Asia, where you're generally not blessed with lots of oil or natural gas, is going to motivate new technologies, which almost by definition are going to be low carbon in nature. But abundance, affordability, reliability, geopolitical security, after that, environmental and climate conditions. And I'll wrap up with just a really short point here. There's almost a perfect correlation between societal wealth, which is also perfectly correlated with energy usage, and how clean your air and water is. Look at a map of clean air. It perfectly correlates with fossil fuel usage. It's not that fossil fuels cleaned up the air. They clearly don't. But it's that it's synonymous with your country being rich, and therefore you can enact strict clean air standards or clean water standards. Trying to get to lower carbon intensity, I think geopolitics are going to be the motivator, as opposed to trying to starve people of energy or forcing them to only use societally approved forms of energy. I think it's going to be a geopolitical motivator, and I think we will get there, but I think the timing's uncertain, and that's where I push back on the 2050 objective, the idea that we know by 2050 we can get there.
Well, it's certainly an aspirational date, no question about it. And even if we get 10% of the way there, I got to believe just the general price and supply demand of all these critical materials to get us to some sort of objective are going to be much higher, much more volatile, much higher, and so forth. So, let's talk about it from a business standpoint. What are you seeing from a business transition standpoint? Are you seeing partnerships, mergers, oil and gas companies changing the way they operate? What is changing? What are you seeing on the business side of things?
You'll know, Ed, it was a really tough last decade for the shale producers, for energy more broadly. The returns on capital, which were good in the 2000s, were terrible in the 2010s. And that's a little bit the nature of it. The cycles tend to be long-term. I've always focused on the long-term profitability cycle. We might call that return on capital employed or cash return on cash invested. There's a few different corporate level metrics to look at. And those cycles tend to be 10 to 15 years up, 10 to 15 years down. We're coming off one of those long down periods. Maybe we're now in year 3 of a new up cycle. But we've also got this uncertainty about what does energy transition mean. So I have a view that oil demand is going to grow for the foreseeable future, same with natural gas, and that there is no round number, year, let alone decade, where anyone can for sure know when it's going to peak. But others have questions. The portfolio managers who say, well, you may be right, Arjun, but others think it's going to go away. Maybe it's something in between. But I know these companies did poorly last decade, so I'm going to demand they give all the cash back to me. And I think I understand that perspective. There's no doubt cash return to shareholders should be a component of every company's business strategy, but no one's acting like there's going to be a future for this business, including oil and gas companies. They are all acting like maybe not this year, but within 10 years, oil demand could plateau. And so what I'd say is, what if that doesn't happen? To me, the risk is skewed towards moving up that energy and economic S-curve for the developing world and continued growth in oil and gas demand. Right now, we have sufficient supply to meet demand, but these companies, for the first time in my 30 years, they are all acting like the business is going away. You can see that in all the mergers. These mergers are generally consolidations, coring up acreage positions, cost-cutting, efficiency gains, with very rare exception is anyone talking about growth or here's exploration or here's other things we should be doing. Now, whether that does motivate new technology development, that's an angle. So I respect companies that are saying we're going to study the new stuff and see if any of it makes sense. We've not had it yet. We've not had investors come back to this sector and say, yeah, we trust you to spend money and some amount of reasonable growth is required. We're not there yet. I think we will get there in coming years.
It sounds a lot like the nuclear, or better put, the uranium market. Everyone sort of forgot about it, gave up on it. Reactors were shutting down, all these things. And there was no new supply coming to market. And we saw it go from 30 to over $100 a pound in a very short period of time. And that seems to continue to grow. Sounds like you could see the same thing happen in the oil and gas industry. And I think it goes full circle back to, I know I've heard you say this on a couple of interviews I watched recently. We kind of need everything. We need it all. And I think that's probably the greatest risk, is I think there's going to be a winner. I mean, the winner is probably going to be us as consumers if we do bring it all to market. What other risks are out there then, I guess, from both a business standpoint and from a consumer standpoint? What aren't we paying attention to that we should be looking out for?
Well, before I answer that, I want to expound upon one comment you said, which I think is very insightful and accurate, in that there's a lot of parallels between what's going on with oil and gas and what's going on in the nuclear space and the metals and mining space more broadly, that I know it's brought you all are experts on and have done some great work and some great podcasts on. And there's a lot of common ground here where the world needs all this stuff. These are the basic materials. These are literal terms. This is the energy that runs the economy, but it was such a bad decade. And software has understandably been exciting and hot, and AI is exciting and hot. And I think that is where the nexus of new world and old world is coming together. It is going to be this artificial intelligence revolution. And I apologize that is a buzzword today. But when people like Mark Andreessen says software is going to eat the world, I agree. Software is eating the world. But all software requires hardware, and all hardware requires energy. And the tech companies are getting today, they're starting to recognize power and energy don't just magically bubble out of the ground. And when we have this ideology, I'll use that term, that it all has to be solar and wind. There's nothing wrong with solar and wind. What I like about solar and wind, I'll start with a compliment, is once it's up and running, it's a domestic resource. You don't import solar from another country. The issue, as we all know, is it's intermittent. And so in the absence of long duration storage or natural gas backup, you're going to have to deal with that intermittency. And your data center does not run only on some sort of cycle. You're going to want to run it 24/7. These are huge power needs. I think big tech is going to be one of the enablers to moving towards a healthier discussion about energy, where we get out of this climate's all that matters and fossil fuels are evil, or vice versa if you're on the other side of the aisle in a political sense of it. And I think big tech can bridge the gap, because at the end of the day, people want to plug in their iPhone and have it work. People want to pull up their Copilot or ChatGPT and have the answer spit out anytime they do it, not just some of the time when the sun is shining. And so I think there's a lot of opportunity to have a healthier discussion on this. And I think tech is going to be one of the big enablers. The big risks are just that in the absence of a healthy discussion on this, in the spirit of where people are now trying to divide groups, you're either pro-climate or against climate. You either support net zero or you're a, quote, climate denier. If you say anything good about fossil fuels, you're just in for that sort of demonization of rhetoric, or the opposite. I don't support the anti-ESG, anti-climate efforts either, which I think are equally challenged, just they're a little smaller in scale relative to the pro-climate stuff. Both extremes I think we could do without. The world needs energy. The world would like a clean environment. The world is going to want to ultimately move to lower carbon forms of energy, if for no other reason than geopolitical security. And so the risks are that by demonizing this, by making it a political event, you're going to result in the worst of all worlds, where you don't have cheap energy. It's not any cleaner than it ever was. And we all face brownouts and blackouts. We've all known that's a risk in the developing world. It's a risk in the developed world.
So that's a great point. Let's stay on the theme of tech for a second, both from a production standpoint.
Yeah.
What technologies are you seeing coming online that are going to make extraction potentially easier, more profitable, or cheaper for the consumer? And then what are you seeing from a tech standpoint on how to consume energy in a cleaner, safer, less expensive way? Let's start with the production side first as it relates to tech.
I mean, on the production side, again, this is going to be a cliche as well, but a lot of traditional energy, I'm sure this is true of metal and mining, these are legacy companies that have been around for 100 years, or certainly many, many decades. They are just now all in the process of moving to modern data architecture. They're cleaning up their data. If you've been around for 80 years and you've done 52 acquisitions, you've got a whole bunch of not clean data that's on a bunch of different systems. And this digital transformation, again, sorry for all the buzzwords, it is going to, I think, revolutionize efficiency gains in something like shale plays. When you think about U.S. shale, which has had massive growth, and people are wondering, is it mature? Is it going to plateau and possibly decline? I think there's a lot of running room to go in at least getting more out of the existing shale reservoirs. There are a lot of wells. There's a lot of zones. There's a lot of different ways to frack. There's a lot of different ways to optimize water and gas handling and all these things. And I think big data and AI is going to be helpful in that. And so that will all ultimately lead to more oil supply. It's still going to be cyclical and volatile. We're still going to need, I think, new exploration and so forth. But it's an example where I think there is an AI argument in the positive sense of enabling additional oil supply out of U.S. shale as an example. I think where there's more uncertainty is on the demand side of the equation. So I mentioned electric vehicles before. I think there's no question that electric vehicles are attractive for a subset of the population. I myself have driven a Tesla for 8 years now. I also mentioned I'm a retired Goldman Sachs partner, so I was able to afford it. I live in a nice house where you can have the charger in your garage. That is not everyone's situation. Mm-hmm. So the idea that you're going to force everyone to buy an electric vehicle, to me, that is what doesn't make sense. I think if it wins in the marketplace, there will be a subset of people that simply prefer driving an EV. And I think if you're China, you're doing it for geopolitical reasons. I think beyond that, it's hard to name the technologies that you can say with high confidence, this is going to work. Example is sustainable aviation fuel. Are we really sure that we can take the cost from 7 times the price of jet fuel to something more at parity? Renewable diesel takes a whole bunch of subsidies and tax credits to have these projects go forward. The inherent cost is double crude oil-based diesel as an example. And so I think we're still working through what are going to be the new technologies. I think nuclear absolutely is going to be part of the answer. I think that's one of where, and you guys are the experts, so apologies for weighing in, but do we need different business models? Is there something that the UAE and China have done well, where in the US, where it's an individual utility doing a project, and then a different utility is doing a different project, so you may not get the cost savings or learnings? Is there a better way to do that? Public-private partnership, those kind of things I would wonder about. What kind of regulatory reform do we need? And then all other technologies, we're spending lots of money on other technologies. So at Veridin and SuperSpike, we take it seriously. We think there's a motivation. What I think is we don't know what is going to scale. We know shale scaled. Shale went from nothing to making the U.S. the largest producer within a decade. We don't know what other hockey sticks are going to happen, but the world is pretending that they do know all these other technologies like hydrogen or sustainable aviation fuels or whatever it is, that they're going to hockey stick up over the next 10 years. And that is far from certain. It is far from certain you can go from science project to lab to pilot project to scale within some short arbitrary time frame, and it could all happen. We just don't know when.
Let's shift to the investor's lens for a second, from their point of view. To be super blunt, how do we make money off of all this? All these things are happening, all these transitions are going on. How, from an investor's point of view, should they be thinking about investing in this space? What should they be looking for? How to allocate capital? How to participate?
So there are obviously many different types of investors out there. I'll give you my personal style, and this is just personal opinion, is I've always taken a longer term approach to the sector, given that is the nature of the commodity cycles. They're 10 to 15 years up, 10 to 15 years down. I used to, when I was at Goldman, deal with some of the hedge funds and clients who were more trading oriented, and some of them did an excellent job of figuring out the shorter term inflections or getting in out of this stock or this subsector and into another. Never been quite my thing. My focus is on who is going to generate excellent long-term returns on capital, who might be not doing as well today on return on capital, but has a restructuring plan to get better, who is committed to dividends and stock buybacks. But where I think we are today is that improvement in the sector from having really poor returns to having at least improved returns, that was kind of the 2021 to 2023 rally in the sector. I think now it's about the stuff we've just been talking about, Ed, is who does have a vision for the future? Who is not simply trying to run out the clock on their remaining tenure as an executive or management team before, quote, peak demand happens? Who is going to figure out how do you work with technology companies? Should you be trying to do something different? If you weren't in the LNG business, as an example, how can you play in that if that is going to be a source of future growth? And I think the answers aren't always obvious. Right now, there's a lot of consolidation in the shale place. I understand it. the cost cutting and the synergies and the bigger acreage positions all make sense. But where are the deals to do more exploration in Africa or in other parts of the world that are going to need oil and gas? Or, as you were suggesting earlier, who's going to crack that code and how can nuclear work with technology? And so, which companies can articulate a positive vision for the future and how they're going to participate in that? There are very few who do that.
I suspect also mergers, acquisitions, partnerships are going to definitely be part of the environment in the coming decade or so as this thing continues to evolve. Yeah. Is that something you're already starting to see, or is that sort of down the road?
Well, so we've seen a lot of M&A already in the traditional energy sector. What we haven't seen is new capital formation. So if you look at the number of energy names in the S&P 500, the major index, it peaked at, I want to say, 43 names, something like that, in that 2010 to 2012 timeframe. And it has generally ranged from low 20s to mid 40s. We, after the recent bout of mergers, if Hess gets acquired by Chevron and there was other mergers recently announced, you'll be down to like 20 or 21 names in the S&P 500. And so we've seen a real shrinkage, a real consolidation in the sector. Some think this trend can continue, and so we may have even fewer names. What I'm wondering is, when do people feel positive about the sector? And it goes into this idea of believing in how are you going to participate in future energy growth while generating good returns on capital and having IPOs and having new companies added. We've not gotten to that portion of the cycle, which tells me from a long-term standpoint, the sector is still sort of under-owned and under-respected, and people still have this idea that it's all going away. If you share my view that it isn't all going away and we're going to need these companies, I think the question I'll ask is, when are we going to get new IPOs? When do we get new companies formed with new ideas? Mm-hmm. We probably don't need another Permian company at this point. That's going in the other direction. Is it the Montney? Is it in Canada? Is it an oil sands name? Is it an offshore exploration name? Where are the new ideas? Who is funding these? There's been a lot of capital that's left the sector. Where are the management teams that have a positive vision? That's what we're looking for at this point. And that is, to me, where there's going to be the greatest opportunity. There's a value element to this sector, but it's really when does the glass become half full again? And you can see it in the merchant power stocks. If you look at a basket of merchant power companies in the US, they've done as well as NVIDIA over the last year. And everyone knows NVIDIA has been a home run AI stock. But look at Talon, look at Constellation, look at Vistra as a basket. They have done as well as a leading AI company because people say we're going to need merchant power. When do we get the merchant power moment coming to the rest of traditional energy?
Talk a little bit about that for a second, because most people, including myself, really don't hear that term very much.
So most people think about power as being done by big utilities that are regulated and they have a kind of a set rate of return and they invest in projects. And that has been the bulk of the business. But it's certainly been for most of my career. There's always been a group of companies that develop power projects on their own. Historically, this was natural gas. Today, it could be also renewables. They're more nimble often than the regulated utility. They don't necessarily have the full spectrum of transmission lines and all that goes with providing power to customers, either businesses or consumers. They tend to have not that part of it. They basically have just the power plant part of it. And it tends to be, I'll just say it, a free market, or at least a non-regulated market, where they generate power and they receive the power price that is prevailing at that hour or that day. And so it can be a very volatile business. It has a decent amount of risk to it. Now, you might contract out some of this power. It's with the business. That is what you're starting to see with some of these technology companies. We are willing to buy this power at XYZ power price for the next 20 years so that you'll develop the power plant and sell us the power. And maybe we're buying that power at a higher than average price so that you can have confidence in developing the projects, or at least we're taking out the volatility of the peaks and the troughs, which the troughs you might prefer to get rid of as a company. So these stocks have been like any unregulated industry, cyclical and volatile and so forth. But what I think the market is seeing today is that there is going to be a lot of power need. And as the grid has become more intermittent, more solar, and as in the US, we've had flat power demand for the last 20 years. It's now starting to grow again. It's growing again at a time we've added all this intermittent resource to the grid. We're going to need more power, full stop. We're going to get more renewables. We're going to need more base load power like natural gas as well. And nuclear is going to be part of this solution.
Anything that I haven't asked, or points or topics that you want to get across before we shut it down?
I think the final point I would just simply make that we haven't talked about is there's this odd thing where in the United States and Canada, we have a large segment of the population that uniquely tries to attack US and Canadian oil and gas companies. And that is something I don't understand. If you don't like oil and gas, I actually don't have a problem with it. If you don't like oil and gas executives, I don't have a problem with that either. I mean, as an investor, as an analyst, we don't like all these companies or these management teams. I get it. What I don't understand is if you're an environmentalist, I respect your right to advocate for the environment. We need people like that to ensure we have cleaner air, cleaner water, and meet other goals. But why are you starting with U.S. and Canadian oil and gas companies? It's against our national interests. It's against geopolitical security. It's against the safety, health, and environmental protections. It's against the environment to attack our own companies. Go after Russian oils. Go after National Iranian Oil Company. I mean, come on. How is this even a question? Go after PDVSA in Venezuela. Why are you attacking U.S. and Canadian oil and gas companies? I honestly do not get it at all. The answer I get, because I am friendly with some folks in the environmental community, believe it or not, is that, well, they're the ones we can go after, and we have to start somewhere. I find that to be a ridiculous answer. And they'll say, Arjun, well, you don't care enough about carbon emissions or this or that or appreciate the urgency. I was like, whether I appreciate it or not, why would you start with our own companies? And we get into a circle on this. It is better for our countries, better for the U.S. and Canada, better for our consumers, better for clean air, better for clean water to have oil and gas and metals and mining produced in the United States and Canada. And I cannot understand the perspective that tries to keep it in the ground here. Keep it in the ground elsewhere if that's your worldview.
I'll tell you, that is starting to, it feels like very slowly change in some of the narratives, but we have a long way to go. You know, Arjun, this was awesome. This was really some great intel today. I would love to have you back on in 6 months or so and see where we are with all this stuff. As you mentioned, these 10 to 15 year cycles, seems like we're in the first couple of years of it. A lot of opportunity, a lot of volatility there. So thank you again for being on here. For anyone that would love to get access to Super Spiked, how could someone find you?
Part of my mission with Super Spiked is public education. I do think this whole narrative needs a range of voices, not just one set of voices. It's at Arjun Murti, ARJUNMURTI, one word, .substack.com. It is for free. It's also on the Veriten website, veriten.com, where at Veriten we provide a slightly differently formatted version of Super Spiked, and also our flagship Close of Business Tuesday weekly video interview that my colleague Maynard Holt hosts. So either way, you can subscribe to Veriten and get both things, or subscribe to the Substack to get my thing. All of that is for free. We have the mission of improving the dialogue around energy, and we're trying to do our small part in it.
Well, awesome. And thank you for helping us do our small part as well. We're just trying to educate people and keep them informed. So again, Arjun, thank you for being on Sprott Radio today.
The pleasure's been mine, Ed. Thank you so much for having me on.
You're welcome. And once again, my name's Ed Coyne, and thank you all for listening to Sprott Radio.
This podcast is provided for information purposes only from sources believed to be reliable. However, Sprott does not warrant its completeness or accuracy. Any opinions and estimates constitute our judgment as of the date of this material and are subject to change without notice. Past performance is not indicative of future results. This communication is not intended as an offer or solicitation for the purchase or sale of any financial instrument. Any opinions and recommendations herein do not take into account individual client circumstances, objectives, or needs, and are not intended as recommendations of particular securities, financial instruments, or strategies. You must make your own independent decisions regarding any securities, financial instruments, or strategies mentioned or related to the information herein. This communication may not be redistributed or retransmitted in whole or in part, or in any form or manner without the express written consent of Sprott. Any unauthorized use or disclosure is prohibited. Receipt and review of this information constitutes your agreement not to redistribute or retransmit the contents and information contained in this communication without first obtaining express permission from an authorized officer of Sprott.